how often do you look at your P&L, and how often should managers on average look at their P&L, and, does it cause bad behavior when they look at it on a daily basis?
I think so. One of my principles is that when you find yourself at the bottom of a deep well, you need to have a rope to get out. What I mean by that is that, so if I go back to 2008 and 09, so at that time, I think it was down like 65, 67% from the peak in 2007 to the bottom in March 2009, we brought it down 2/3. And I used to be managing like 600 million in 2007, and I was managing less than 200 million in 2009. And everything looked beat up, right? And so what I did, I think the rope I used at that time was I just created a spreadsheet which showed me what these businesses were worth and what the portfolio was worth. And the portfolio was actually worth more than 600 million. And so I didn't fixate on, the market value is so much and this and that, because again, we're not looking for the market to instruct us. We have other places to get instructed.
To serve you, as you said.
And I think from March 2009 to December 2009, the funds were up like 135%. And they kept going after that because we could see the businesses and we could see what it's worth. Even when we looked at this business in Turkey, Resas, at 20 million, I did all the due diligence. I couldn't come up with a valid reason. I asked myself whether the guys were crooks, whether everything was fraudulent, whether those places actually existed. I went and visited all the warehouses and I met the management, and they looked like perfectly honest people to me. And so I couldn't find anything wrong with it. And so we're not going to use the stock price to instruct us. We're going to use fundamentals to instruct us.
If you were to give advice to young people who are looking to start their own investment partnership today, what kind of advice would you give? What sort of pitfalls and traps should they try to avoid? And how should they go about forming the partnership?
Yeah, so I would say that, even if you start with a very modest sum, let's say, for example, you started with $10,000. And let's say you were a very gifted capital allocator, able to compound money at high rates. If you were, doing 20, 30% a year, let's say 25% a year, that 10,000 would be doubling every 3 years. And if you went for 21 years, for example, it would be 7 doubles. I think 7 doubles is 128. Okay, so you would have like more than 100 times the 10,000. So you would have like 1.25 million or something. So I think that there should be a couple of conditions in terms of managing money for others. Number one, you should be independently wealthy. So if you've compounded well with your own capital for some period of time, basically just the nature of compounding is that you'd be quite wealthy. And then at that point, once you're wealthy, whether you manage money for others or not becomes irrelevant, because you continue to compound and do well even if you never. So if you were 20 years old and you were doing this 20, 30% a year, by 41, you would have over 1 million. And by 71, you would have over 1 billion without ever adding anything to the 10,000 you started with, without ever managing any money for anyone. So my take is that the first rule should be that you should have proven that you are a great investor, and the proof would be that you'd be independently wealthy. And yeah, if you've done that, then at that point, if you said that you wanted to manage money for others, I think that would be a relatively easy thing to do. In fact, they would find you. A lot of people will find you and want to give you money. You wouldn't even have to spend much time looking for them.